Welcome back. Today, we're jumping straight into a 360-degree explainer on Sanofi. We are breaking down their exact position ahead of the Q2 2026 earnings report. So if you want to understand the actual mechanics driving this global pharmaceutical giant right now, you are definitely in the right place. Okay, let's get anchored. We're gearing up for their Q2 2026 results, and we've got a highly structured approach to cutting through all this dense corporate data. Thursday, July 30th, 2026. That is our finish line. Today, we're unpacking the exact macroeconomic, commercial, and pipeline metrics you've got to understand before those numbers actually drop. We're going way beyond just top-line revenue to dig into the real, underlying drivers of the business. Here's our game plan for today. We'll start by approaching the Q2 earnings landscape. Then we'll check under the hood of the Dupixent growth engine. After that, we'll look at vaccine and rare disease sales, followed by R&D, expenses, and debt. Then we'll highlight a massive pipeline win with the Sanofi approval, and finally, we'll wrap up with their ESG and sustainable finance strategy. All right, part one, approaching Q2 2026 earnings. Right off the bat, based on year-to-date currency rate movements, we are looking at an estimated negative 2% impact on sales for the second quarter. And honestly, what's even more crucial here is that this translates to an estimated negative 3% hit on business earnings per share. This is your foundational metric for July 30th. Before we can celebrate any sales growth, we've got to factor in this currency environment that's dragging those raw figures down. Moving into part two, the Dupixent growth engine. You just have to look at the sheer scale here. Dupixent generated 4.17 billion euros in Q1 2026 alone. That is a massive 30.8% growth rate. But context is everything, right? That growth was partly boosted by a lower base of comparison in the US back in early 2025. As we move into the second half of 2026, Dupixent is going to face a much tougher comparison base because of past launch dynamics. Plus, tying back to our last point, since they have such a high proportion of US sales, Dupixent is incredibly sensitive to the US dollar. Okay, Section 3, Vaccine and Rare Disease Sales. The momentum in the rare disease sector is honestly undeniable right now. Established treatments like Altuviiio are absolutely soaring, up over 42% to 325 million euros. Then you have Ayvakit, which was brought in following the Blueprint acquisition, and that's up a very healthy 38.4%. Meanwhile, the newer approvals from 2025, like Wereluz and Qfitlia, well, they're just starting to find their footing, but they are already contributing crucial early revenue streams to the portfolio. On the vaccine front, polio, pertussis, and Hib are really leading the charge at 664 million euros, and that actually includes the hepatitis B vaccine from the Dynavax acquisition. Beyfortus also pulled in a solid 284 million. Keep in mind, though, vaccine sales are notorious for heavy seasonal fluctuations. For instance, flu and COVID-19 vaccines took a totally normal seasonal dip in Q1, missing those late-season immunizations that really padded out previous quarters. All right, on to part four. R&D, expenses, and debt. This is where we see some real internal friction. On one hand, R&D spending is holding pretty steady at 1.7 billion euros, maintaining a very stable ratio to net sales of 16.6%. But then you look over at the commercial side. Selling, general, and administrative expenses are climbing sharply, up over 11.6% to 2.3 billion euros. That is trending noticeably above the annual growth rate we saw in fiscal year 2025. Now, let's talk capital structure. This trajectory tells quite a story. Notice that massive plunge in debt down to 5.1 billion euros back in Q2 2025? That was thanks to a huge 10.7 billion euro net cash inflow from the Apella divestment. But look at what's happened since. It has steadily climbed right back up, hitting 12.9 billion euros by the end of Q1 2026. Analysts are going to be watching this rising net debt position like hawks to see how it impacts net financial expenses. Let's pivot to part 5, pipeline win, the Sanofi approval. This timeline is a textbook example of pipeline resistance. Back in December 2025, Sanofi took a real hit when the FDA handed them a complete response letter for tolebrutinib. But the narrative flipped entirely in Europe. By April 2026, they grabbed a positive opinion from the EMA, which paved the way for a landmark final EU approval in June under the brand name Sanofi. So why is this such a big deal? Well, Sanofi isn't just another drug sitting on a crowded shelf. It's a true first-in-class treatment. Literally, it is the first and only disability-targeting therapy approved in the EU for patients with a very specific, progressive form of multiple sclerosis. Make no mistake, this is a game-changer for Sanofi's neurology portfolio. Finally, Section 6, ESG and Sustainable Finance. What really stands out to me here is how Sanofi is literally tying its capital structure to its corporate conscience. They are real pioneers in this space, using sustainability-linked revolving credit facilities and issuing bonds that are tied explicitly to the performance of their global health unit. Their updated AIR strategy proves they're serious about aligning global health outcomes with environmental responsibility. So, I want to leave you with this thought as we wrap up our explainer today. We've seen the absolute powerhouse growth of Dupixent and the expanding rare disease portfolio, right? But we're also seeing climbing internal expenses and rising debt. With massive European pipeline wins like Sanofi finally crossing the finish line, what will those July 30th numbers actually tell us about their ability to execute? Keep these core metrics front and center when you tune into that earnings call. Thanks for hanging out with me for this explainer, and keep learning.